Hello everybody, welcome back to my channel where we talk all things finance and investing. In today's video, I'm going to try and tackle the question of whether or not we are in a stock market bubble. I had some questions on this in comments on recent videos, plus it's all the talk right now in the media. The word bubble is being thrown around like crazy. Just this past week, the CEO of Goldman Sachs alluded to it. Jeff Bezos as well mentioned it, and it's just all over the press. So I thought let's discuss it on today's video. So on that note, let's get right into it. Are we in a stock market bubble? Okay, so there's a few metrics that I want to have a look at to really help us answer this question. And probably the most popular metric of all when it comes to valuations is the price to earnings ratio. And all this really looks at is really the earnings of a company and the price of a company through the share price. And of course, you can do that for the entire S&P 500 as well. So simple example, if a company is earning $10 per share and their stock is trading at $50, then you have a PE ratio of 5 in that example. That's really how the math works. Now that's for an individual company, but you can do it for the S&P 500 as well. You just look at where the index level is, so around 6,700 at the time of filming this video, and what the previous 12-month earnings per share for the entire S&P 500 is, or for what the projected forward earnings would be for the entire S&P 500 for the 500 companies, which is in and around $280 or so. So with those two figures, we can work out what the ratio is. And of course, the higher the number, the more that you have to pay for those individual earnings, and therefore the more overvalued it would tend to be. We also have something called the cyclically adjusted price to earnings ratio. And with that, it'll actually smooth out any economic cycles that you might have, factor in inflation, and look over the last 10 years of earnings for a particular company or an S&P 500 in our example, and you'll be able to work out the cyclically adjusted price earnings ratio. And it's generally very popular, like the PE ratio I mentioned as well. So let's have a look at a chart here that JP Morgan Asset Management put out, where we can see a chart on all of this stuff and where we're at on the PE ratio and the CAPE ratio. All right, so on my screen, we've got the chart here, the S&P 500 index forward PE ratio, meaning we're just looking at the forward earnings over the next year. And have a look at the chart. So the valuation measure, that column, we got the PE and the CAPE ratio. There's also a dividend yield and earnings yield spread on this chart as well. But we're going to focus on the first two, really. I think they're the most important as well. So if we look at the description, we've got the forward PE ratio, the latest number on that, and this is again for the S&P 500, 22.8 times. Okay, so the higher the number, the more richly valued we would have, right? Or the more higher value you would have in this case. If you compare that 22.8 times to the 30-year average, it was 17. So therefore, we are quite a bit more valued right now than the last 30-year average for the S&P 500 on a price to earnings ratio basis. So that would tell us, relative to that number, we're in an overvalued territory here. What about the CAPE Shiller PE ratio? The latest on that, 39.8, so just about 40 actually on the CAPE Shiller PE ratio. The 30-year average on that is 28.4. So that's really telling us, frankly, that we are in an overvalued territory here. Now, to know whether that means we're in a bubble or not, we really need to look at, history and particular bubbles that we've seen and get an idea where that ranks. So if you look at the chart and you look around the year 1998, 1999, sort of on the left-hand side here, you can see that the forward PE ratio actually got up to 24 times. Now that was a serious mega bubble. That was when I started my career in finance. And it was absolutely crazy. And to think that the S&P 500 is right now 22.8 times, that was 24 times. I'll tell you what, that tells me that we are potentially in a bubble just by looking at that figure. Let's fast forward a little bit. If you look at 2007 though, now remember we had a mega crash in 2008 and 9, but if you look at 2007 on the S&P 500, it was actually quite low. So it doesn't really tell us exactly that we are in a bubble. Now, of course, that was a housing bubble, so it was a little bit different, but the stock market still cut in half roughly the S&P 500 when that bubble bust as part of the global financial crisis. But it wasn't stock prices so much that brought us into that. It was housing prices. So we need to think about that as well. But if we fast forward a little bit to 2020, as you can see, it shot down at the beginning of the pandemic, and then it rocketed right back up, and it went up, you know, to around about where it is right now, and 2021 as well. And we know what happened in 2022. Of course, the market sold off around 22 times. But that was mainly due to the increase in inflation that led to an increase in interest rates. So the PE came right back down through 2022, 2023, but it's come back up like we see here at 22.8 times. Okay, so that's one of the most popular metrics. And if I look at that, I have to kind of come to the conclusion that we are in and around, or at least just starting to get into bubble territory. And the main reason I say that is I just compare it back to 2000, where it was up around 24 times. Also, I want to compare it back a little bit because at that time, of course, it was the internet boom. And right now we have kind of the AI boom, if you will. The CapEx spending in AI infrastructure is massive, and what's really driving this. So while I wouldn't immediately conclude from one metric, definitely we're in a bubble, this one is definitely giving us some stuff to think about, and it's certainly giving an indication that we are. All right, so the next metric we're going to look at here is the famous Buffett Indicator. This one is very popular as well, and it's super, super simple. More simple than, say, the price-to-earnings ratio that we just discussed. And the Buffett Indicator is really the total value of the US stock market, all the shares listed on the US stock market called the Wilshire 5000, and the total value of the US economy as measured by GDP. So if you take the total value of the stock market right now, it's in and around $65 trillion. And if you take the total value of US GDP, it's in and around $30 trillion. So if you divide the total stock market value of 65 trillion over the GDP of 30 trillion, it works out to be around 217% right now. So it is much more than double the amount. So it sounds like a big number, 217%, but in reality, just like the PE ratio, we have to see where it's been historically to kind of come to any conclusions on how it compares. All right, so have a look at this chart. We've got here the Buffett Indicator, US stock market value to GDP, as provided by a great website, by the way. I encourage you to look at currentmarketvaluation.com. Links in the description. In the sources, you'll find all of this stuff. So go have a look at this if you want to dig deeper. But this is the Buffett Indicator. And if you look on the right-hand side, now it's as of June 30th, 2025, according to this chart, about 217% ratio of market value to GDP. 69% higher than the long-term trend line. Now, look at the chart going all the way back to 1950. As you can see, we saw a massive increase in this in 2000, where it was up to almost 150%. We all know what happened then, dot-com boom and bust. And then it came back down. Look at the bottom of 2010, just before 2010 actually, where it came down to being just a little over 50%. That is incredible, but it has done a rocket ship since then, and it's now up to 217%, which is basically at all-time highs. So the Buffett Indicator would tell us that this market is overvalued, and you could probably conclude we're in a bubble looking at this. Now, there is one thing that I want to point out when it comes to the Buffett Indicator, because it uses gross domestic product. So it wouldn't account for sales that are done internationally. And now, compared to, say, the 50s and 60s when this was done, you have a lot of American companies that are earning money outside of the US. So therefore, those earnings are being made outside the US. They're not a part of US GDP. They're brought back and factored into the share price. So of course, this is going to be a little bit distorted and make it seem a little bit more overvalued than it would normally for that reason. So I'd like to, just throw that out there. International sales are not really being included in here, so that could make a difference. But even with that factored in, a 217% Buffett Indicator is not a good sign for market valuations being good or future returns from stocks being great, just purely on the basics of that. So if we look at the Buffett Indicator, we have to conclude we're in a bubble. Okay, the last indicator we're going to look at, for me, I think it's an important one, and that is the number of IPOs, initial public offerings, in the US on the stock markets there. If you don't know, an initial public offering is when a company goes from being private, not having their shares listed on a market, they're privately held, to deciding they want to list it publicly so anybody can buy and sell shares in a matter of minutes through their brokerage account via the stock exchange, of course. Okay, and the thing about IPOs is companies like to go list their shares in the stock market when they believe they're going to get the best price possible. Once they have everything else, their strategy determined and they know they want to go for an IPO. You don't do an IPO when you're not going to get a good price, and you're only going to get a good price if the market is hot. So what you see happening is when companies go for IPO and they get a better price than maybe they normally thought, it means their valuation is higher. So more companies will see that and decide now is the time to act quickly and get our shares listed on the market because we're likely to get a very high price for it. And that can be a very good indicator of the market being overvalued because there's such an appetite for IPOs to happen and they're getting much better valuations than they maybe would have a year or two previous. I can tell you with certainty during the dot-com boom, IPOs were unbelievable at the time. You had companies listing that had nothing to do, no sales, no revenues, no profits, but they said they were going into the internet business, and their IPOs absolutely rocketed for that reason. And that to me is a very good indicator that we would be in a bubble. So what is happening right now with IPOs in 2025? Well, if you have a look at this table on the screen right now, put together by stockanalysis.com, IPOs, then you get an idea of what's been happening historically and what's happening right now. So I've marked a few years off, look at 2000, so 397, which actually wasn't that bad. But if you look at 2001, 2, and 3, a whole lot less IPOs came to market. It held pretty strong. 2007, which was just before the global financial crisis, there were 268. That's a good number, but not a huge number if you compare it to 2000. But again, the global financial crisis was mainly caused by housing, not by incredibly high stock prices or stock valuations. Like we saw in the dot-com boom and bust. And then you can see, look, 2008 and 9, there were barely any, of course, because why would you list your shares on the market if the market had no appetite for it, and therefore you'd have a poor valuation. And as we go right through, look at 2020, 480, and that was because all the liquidity we had, valuations were high. Remember, there was a lot of talk of SPACs at the time. That was driving a lot of this. 2021, we get rocket ship level IPOs, 1,035. That is an indicator of valuations being super high. And of course, a lot of those SPACs turned out to be nothing. They went bust, they dissolved, whatever. So it didn't work out too well in 2021. Where are we now? So far, 271 IPOs year to date. That is high, but it's actually not too bad. Now, what you want to do when it comes to this really is you want to watch what the IPOs that come in and around the kind of frothy areas like AI, and you want to get an idea whether or not they are doubling, tripling, or even more on their IPO day, and what their revenues and that are like. We have had a few that come through where they barely had any revenues and earnings, and their IPOs have done extremely well because they're in and around the AI business. And this is classic sort of bubble territory. So if we start seeing more of this in the last part of the year here in Q4, then you can come to a conclusion that we are definitely entering bubble territory. This to me is one of the biggest indicators because I lived through it in the dot-com boom and bust. But it's not the be-all end-all. We saw it with the global financial crisis. There wasn't so much IPO activity. So watch AI IPOs in particular. If it starts getting really crazy, then you can start coming to the conclusion that we're really properly entering bubble territory here. So there you have it. We got 3 metrics there that pretty much telling us the market is overvalued and we could be entering bubble territory, if not there already. I can tell you it's sometimes very hard to know you're in a bubble. I did feel we were in a bubble in the housing boom and bust for sure. And I did think we were in a bubble in the dot-com one. To me, it was fairly obvious. Although I was new and just starting out my career, I didn't have that much experience. I think we're entering into a bubble right now, that's for sure. But it's not the be-all end-all, and it doesn't mean you need to go liquidate everything, all your stocks, and run for the hills. What you need to do is think about your own risk tolerance. Could you handle your portfolio dropping by 30, 40%, maybe 50% over the next year or two? If you can't, then you need to think about reducing your equity allocation a little bit so that you can sleep at night and you're comfortable. That's what this is all about. And if that's not feeling right for you, then you just need to take the steps to reduce risk a little bit. That's what I tend to do. If I find myself very uncomfortable, then I log in and I don't do this very often, but I would kind of reduce maybe 10%. So my equity allocation goes down by 10%. I take that cash and I just buy like a money market fund or a short dated government bond maturing in less than a year. And that allows me to just be comfortable. And of course, if we get a big sell-off, doesn't matter how bad the headlines are, I will put that 10% back on. You cannot time the market perfectly. Nobody can do that, so don't think you can, because the pros can't do it, so you can't do it. But you should be able to sleep at night with your portfolio. So if you're worried and you're not sleeping well and it's got you a little bit anxious, then that tells you you've got too much equity allocation on. But be ready, because if the market does sell off over the next year or so, and nobody knows when or if this will happen, be ready to buy when the market does sell off and the headlines are scary as can be. That is the time to consider start buying. So there's my video on whether or not the stock market is in a bubble. I hope you liked the video. If it did, click on that like button. And if you haven't done so, subscribe to my channel. I would really appreciate it. It just takes you a second to do so. I'll put a link in the comments. You can actually click on that and it'll take you right through to the part of the page where you can subscribe. So thank you if you would take a minute and do that. And share the video with friends or anyone else that you think might like it. Leave me a comment and tell me what you think, whether or not we are in a bubble or not. As always, I wish you nothing but the best in your savings and investment journey.